Aloha, folks, and welcome to this latest edition of Five Questions, a conversation with those in the know here in our state and beyond, which appears here on News Radio 830 KHVH, and also log on to HawaiiReporter.com, and you'll find Five Questions right on the homepage. Boy, talk about timely. It is a delight to chat with Lowell Kalapa, who is the Executive Director of the Tax Foundation of Hawaii. And first of all, Lowell, thanks for being with us for Five Questions. Hello.
My pleasure. How are you?
I'm fantastic. I want to thank you for a recent conversation we had on KHVH, but I think for our friends who are dialed in, could you do us a favor and tell us about the Tax Foundation and a very important aspect that the Tax Foundation is not associated with government in any way?
Well, Rick, and that's because a lot of people see us appearing before legislative bodies at the state legislature, city council, and so they figure we're an appendage of some government someplace. And thankfully, we're not. We're an independent, nonprofit research organization that's been in business over 50 years, and our job is basically to keep an eye on government and to interpret what's going on for the average guy out there, the taxpayer, and to keep them informed of what government is doing as far as their taxes, both collecting them and imposing them, as well as spending them. And it's really critical that we basically, and maybe some of your listeners may not like it, but we try to dumb it down because taxes are complicated and often hard to understand. And a lot of people appreciate the fact that we just kind of put it in plain old English so that people can understand that. Because we're not a part of a government agency, we rely solely on public support, and so we do appeal to your viewers to support the foundation by going to our website, tfhawaii.org, and they can make a donation there, or they can send a contribution in to Tax Foundation of Hawaii, 126 Queen Street, room 304, Honolulu, 96813.
Excellent. Good way to start, so folks, so we're all on the proverbial same page, and we thank you for that, Lowell. I do want to go to question number one, and that is, if you'd be so kind to provide an overall explanation of what our tax system is here in Hawaii.
Well, the three major taxes around the country are all imposed here: income, sales, and real property. Income and sales, or the general excise tax, are imposed by the state. The real property tax is imposed by the county. And that is the only tax that the county really controls, is the real property tax. The income and general excise tax make up the bulk of what we call our general fund revenues. That's the kind of the overall checkbook for the state, and it funds all the programs that don't have a designated source of funding, like education and welfare, as well as prisons, corrections, the Labor Department, the Human Resources Department. So these are all general fund finance organizations. However, it's welfare and education that take up probably around 80% of the state budget. And so it's hard for lawmakers to cut spending because they think those two are sacrosanct. And we don't believe so. We think that with some good common sense and some really creative engineering, some of the services in those two particular areas can be transitioned so that they're not as costly to us, and they actually improve the outlook for Hawaii's people.
Excellent. Thank you for that very much. Would like to go to question number two, Lowell, and that is, as a state, where does Hawaii rate in the rest of the nation in overall taxes that are ultimately paid by its residents?
If we're talking about per capita, that is the amount per person resident here in Hawaii, we're probably in the top five, vacillating somewhere between 3 and 4 each year, depending on what happens in other states. And again, it's mostly taxes paid by residents as well as some of our visitors here to Hawaii. We don't have the luxury of having what's called severance taxes or mineral taxes that some of the other top 5 states have, like Wyoming and Alaska. Alaska taxes its oil, and that oil is sold to us, and of course we end up paying for part of those taxes. The same thing with Wyoming. It relies heavily on its copper resources, which ultimately goes into my water pipes at my house. So they can export taxes much easier than we can, although a lot of people say, well, you have visitors and they come to Hawaii and spend, so they're paying part of our tax burden, and while that's true, it's only true to the extent that we can keep those visitors coming, landing and getting off those planes and spending money here in Hawaii. As you know, we've gone through some very difficult times recently, and that's why our tax revenues are down, is that our major economic component called tourism has not been doing as well, and so the revenues aren't coming in like we enjoyed in the past. But those are the three major taxes. We have a heavy reliance on our general excise tax. It accounts for over 51% of our state general fund tax collections, and that's because it's a very comprehensive tax. And even though people look at it and say, well, gee, it's only 4%, and I just pay 8 or 9% in California, it's because the general excise tax is so comprehensive. It applies to every single transaction that takes place here in Hawaii, and as a result, it's erroneously called a sales tax because sales taxes generally apply only to goods or products and then only at retail consumption for final consumption. Here in Hawaii, the general excise tax applies to not only goods but services as well, and services make up about 60% of the economic base or tax base for the general excise tax. So you can see if we didn't tax services and had just a retail sales tax, the rate in order to generate the same amount of money would have to be somewhere on the order of, at a 4% that we statewide impose, would have to be something on the order of about 11 or 12%.
Yeah. And then on top of that, of course, here in the county of Honolulu, we have a 5% surcharge, or 0.5%. Yeah.
Right.
We're talking with Lowell Kalapa, who is on board with us as the executive director of the Tax Foundation of Hawaii. And for this edition of 5 Questions here on KHVH Radio and also on HawaiiReporter.com. I'd like to go to question number 3, and this has to do with recent legislation, Lowell, of that may have been passed, or if there has been the call for the expiration of various tax credits, etc., that will contribute to our overall tax burden. What have we seen recently, and what's to come?
Well, as far as legislation passed this 2011 session, there are 3 probably major bills that will increase the cost of living that contributed to or will contribute to the state general fund. The bills that passed include 2 income measures that take away deductions for some taxpayers. For example, you no longer will be able to deduct your state income or the state general excise tax on your itemized deductions. And for us here in Hawaii, as I just mentioned, the income and sales tax or general excise tax make up the largest part of our tax burden here in Hawaii. So that's really going to hurt a lot of people who usually take that deduction. The other one is the fact that for quote-unquote rich people, people with 6-figure income, there's going to be a cap on the amount of itemized deductions they can take. And as a result, it may skew people's habits or, for example, charitable contributions. If you're going to be subject to this limitation, you may not be able to deduct all of your charitable contributions because you'll hit the ceiling. That being the case, then it's going to affect, it's not only going to affect the individual, but it's going to affect the charitable organizations that a taxpayer would normally contribute to. And there are a few people that make some major large contributions, and the organizations that have been beneficiaries are going to hurt as well. So those are 2 of them. The other one is in the general excise tax area, and that is for the next 2 years, some of the exemptions that have been granted for years and years under the general excise tax will be suspended. And the major one I'm concerned about is the exemption from the 4% rate for what's known as stevedoring activities. That is the loading and unloading of cargo over our state's docks as well as at our airports. Because as you know, nearly 98, 97% of what we consume here in Hawaii comes over those docks and through our airports. The result is that 4% tax is going to be added for that activity, and it's going to be embedded in all the goods that we consume, from the bag of rice to the box of cereal to even the produce that we get from the neighbor islands will all be affected by that, and that cost is then again going to be passed on to us as consumers. So while we're not going to see the tax increase directly, you and I will be paying more for the food we eat, the clothes
Right.
we wear, and so on down the line because they're all imported either from the mainland or from our neighbor island counties. And so that's a major increase. Construction costs will also go up in the 2-year period because they've suspended the exemption for what's known as the subcontractor-contractor deduction, such that where each party in that relationship paid 4% on their respective income, the tax will now be imposed at 4% twice on the amount that's ultimately turned over to the subcontractor, because the contractor is going to pay 4% on the whole pie, and then the slice that goes to the subcontractor will again be taxed at 4%. So that'll raise the cost of construction here in Hawaii. So those are recent developments that are going to sneak up on taxpayers this coming year. And in some cases, as far as the income tax and the loss of itemized deductions or the loss of the deduction of state income or general excise taxes, may come back to bite the taxpayer in April when he discovers that he's going to have a lot more income subject to tax than he thought he had, and may have to pay additional liability in April.
Well, it's astounding. Just as a sidebar, and I know we're going to go to question number 4 and 5, but having recently had great discussions about leasehold and the amount of money that's being charged by the leaseholders, these built-in, almost these surreptitious, secret types of increases in cost, by the time the consumer turns around and sees that gallon of milk has gone up another 15, 20%, or cost of an automobile, or a cost of going to a restaurant, and all of this, all these hidden charges ultimately are paid by us. And
right.
It's just astounding that the demands on the finite amount that we have in our paycheck, the great demands continue on that amount of money. It's, my goodness, I don't know when it's going to slow down, if it's ever going to stop, reverse itself, or what have you, but it just seems to be more of a challenge every single year.
That's true. And the thing is, it'll get even worse unless we can control spending, and that's what's really critical. Is it's been difficult for lawmakers to cut back, this thing they call spending, because it takes care of various constituents, and so they're not willing to make the hard decisions that lawmakers are expected to make in a time when we don't have the resources.
And that really was one of our questions. Our last 2 questions was about spending and that direct correlation between taxation and spending. But we also have a real, very profound burden of unfunded liability in regard to employee retirement systems, things of that nature, healthcare programs. I mean, that's kind of like the 500-pound gorilla sitting there. Can you help us understand that if we continue on this route and continue with these obligations, but they're not being funded with any other resource, ultimately it comes to us via taxation, how would that be affected, and how much money are we talking about here?
Between the employees' health trust fund as well as the employees' retirement system, it's estimated that the unfunded liability could be anywhere from $4 to $6 billion. And we need to begin to address it because there's some federal laws that require us to ensure that there's full funding of those future benefits within the next 10 to 15 years and over a 30-year period with respect to the health benefits. The problem is that we have been short-sighted in the past when the employees' retirement system, for example, was doing very well and turning out excess earnings, that lawmakers dipped into it and transferred the money over to use in state operations. And now that the market is not doing as well, we have to make up the shortfall, and we will have to make the shortfall should we continue to not do well as far as our investments are concerned. That being the case, then there's almost a guarantee that taxes will have to go up. And somebody's probably out there saying, well, is there a way we can avoid it? And we certainly need to, and we need to bite the bullet quickly, and that is we need to begin to look at curtailing the generous benefits that were paid out or promised to current and former employees insofar as retirement and health care. As you know, the state is one of the few remaining employers with what's known as a defined benefit plan, pension plan. And this is where you're guaranteed a payment of X number of dollars upon your retirement based on your earnings record and the number of years of service. Most companies in the private sector dumped on those. I mean, that was one of the major reasons why General Motors had to go through a restructuring during the last financial crisis, because they still hung on to their defined benefit plans, which are very, very costly and expensive. Most private sector companies have gone to what's known as the 401k plan, which basically is a savings account for employees that they set aside a part of their current compensation for future benefits in retirement. And that's a much more disciplined plan. You don't just sit there and say, well, I don't have to worry because government or the defined benefit plan is going to take care of me when I retire. I've got to be prudent and set something aside. Now, some employers do match contributions to a 401k, but most are very, very minimal as far as the match is concerned. So the defined benefit plan that continues under the employee's retirement system is going to get more and more expensive, and because people are living longer, retirement benefits are going to be continued for a long, long time. And with respect to the employee's health benefits, I don't know if many people know, but the employee's health trust fund guarantees benefits for not only the employee, but in some cases for the employee's spouse, even though the spouse may not have been a public employee.
That's right.
The other thing that we had a very difficult time trying to explain is that unlike most private sector Social Security beneficiaries, when it comes time to join Medicare at age 65, the premium that is paid for Medicare participation comes out of your Social Security check. And it depends on whether or not you are a high wage earner or a low wage earner. The minimum is still about $100 for the low wage earner. And what happens is in the state, because of our generous benefits, the amount of the premiums taken out of the state employee retiree, but the state then reimburses the retiree for the amount of the Social Security premium or the Medicare premium. I mean, that's like free money, so they're paying nothing for that health benefit as opposed to what's happening in the private sector. And that's something that probably cannot continue, or if it's going to be continued, should be continued at the very minimum.
Amen. Understand. Lowell Kalapa with us, Executive Director, Tax Foundation of Hawaii, covering a lot of ground with us here today, and we deeply appreciate it. Once again, Lowell, how about that invitation to come see you, and how can folks support you?
People can call my office at 536-4587 if they'd like to come in and chat about, issues that concern government finances. We're located at 126 Queen Street, room 304, 96813. Or they can go to our website and leave an inquiry there. The website is tfhawaii.org, and it's also where they can find our weekly commentary.
Excellent. Well, Lowell, thank you so very much. We do appreciate you greatly, and can't wait till we do it again. Thank you, Lowell.
My pleasure.
All the best. Bye now.
Take care.